Oh, okay. Now the recording has just started. Uh, 5 people in the collaborate. Let me just check how many people are in the um, today's forum. I have 6, so almost everyone is here. Um, just to let you know, I don't know if you have. Okay, I have 8 people now. I have 8, uh, and someone hasn't signed into. Someone hasn't signed into today's forum. If you haven't signed into the discussion board, please do it ASAP, because you don't want your uh, record of attendance to go wasted. I mean, you don't have any until you uh, until you report your attendance in the today's forum. Your attendance is not validated. You don't have any physical proof of attendance. So please, um, uh, Khalid, you don't have to leave the session if you didn't. You don't have to leave the session to go to the discussion board. You can just simply, open another window. Now, just to let you know, if you haven't noticed, not the announcement. What was that? In the assignments folder, the latest test results are posted there with the attendance as of Tuesday, which was yesterday. And if you download it, if you download it, you will find the latest result. I mean, that's ROI concept check and ROI practice, and the mean of the weighted average, because not everyone did that, right? This is just about the mean of the average. And see, interesting thing is people who are above the mean have done both tests, and there are some people who did both tests but still below the mean of the average. But most of the people below the mean of average haven't done missed one, at least one, right? And then and below this, these little people that has done neither, right? Neither. And then some people don't even have any record of access, right? Some people had the last access. For some people, last access was August 31st, right? But you can find it there, okay? All right, and this is the forum. I have 8 people in the forum. Khalid, Khalid, are you here? Right? Khalid, can you hear me?
Yeah, I'm here. I'm gonna do it
Khalid,
now.
you
Yeah,
need to do this. I don't see your name here.
I'll do it
I mean,
now.
you're not, you're losing 0.167 point, right? For not,
Wait,
uh, having any proof of attendance, right?
Yeah, I do it every.
Mm-hmm. All righty. So last on Monday, we wrapped up everything about the monetary policy, open market operation, and how it affects the Fed funds rate. So we are pretty much done with the first topic. So we want to move on to the next topic. But before we move on to the next topic, let's think about the risk, okay? Because we are talking about the bond, right? Because a bond is the very basic form of financial security. Um, Unlike stock, right? Bond is a lending, so and it has fixed income, right? Fixed income meaning the coupon interest. So valuation bond has a lot lower volatility, a lot less volatility, a lot less risk than the stock because stock has a lot of huge volatility. Yesterday the market lost almost like market lost about 1 point something 1.3%. Yeah, because uh, I know. I lost about 1.3% yesterday. And yesterday, everybody lost. Um, I did. I lost. Let's see. Uh, what was the? Yeah, I lost about 1.3% yesterday. And since uh, I hold a well-diversified portfolio. I wouldn't say that quite well-diversified. I'm heavily into my portfolio is more more into the tech stocks. So more closely aligned with Nasdaq rather than S&P or but still uh, even in the assets that are more into S&P or Dow Jones, I still lost a lot. Overall 1.3. So, but today the market bounced back. But this is the inherent nature of the stock, the volatility, right? But bond has very little volatility because bonds price has some volatility, uh, or rather than volatility, variance. Bond price as every day it fluctuates, but it's not as uh, dramatic as stocks. Uh, but on the other hand, bond pays a constant fixed income. You all understand bond pays coupon. Coupon is a fixed payment. So bond has a lot less volatility. I mean, since your cash flow, uh, your income is uh, more steady. But then, what is the biggest risk in bond, right? And we all know, the greatest risk, the greatest concern, if you are a bond investor, is the default risk, right? Your If you're a bond investor, your greatest concern is whether your borrower, right, will default the company, right, that sold the bond, whether they will uh, default on your payment or not. So default risk is the greatest risk. And other than the default risk, what kind of risks are there? There is liquidity risk and maturity risk and inflation risk. Now, if you think about it, default risk and liquidity risk are specific to the bond, specific to each company, right? Specific to each company, because all companies have different credit ratings. So the credit ratings represent the risk, default risk. Of course, the higher the credit rating, the default risk is low, right? Very low. But the lower the credit rating, the default risk is high. So it is basically a firm specific, firm borrower specific risk, and also liquidity risk is also borrower specific. What is a liquidity risk? So I'm gonna liquidity risk is the risk of being unable to sell the bond of a little known issuer. Now, if the company is little known, right? Obviously, you don't feel very much like buying their bond, because they are it's only natural, right? You don't want to you don't trust unknown company that much. You don't trust a stranger that much, right? That's only and a relatively unknown company. Unknown meaning it's not only it's unknown to the financial market either, and it's unknown to financial market too. I mean, not unknown, but little known. So obviously their credit rating won't be that good either. Won't be that high either. Or maybe it could be. I mean, it's a new company, but with a huge, capital. So the credit rating may be good, but it's a new company. It's just not well known. Again, the bonds of a relatively unknown company are hard to sell, and because you are unwilling to hold, you're reluctant, so they will have to add premium, right? They will have to add premium is in the form of higher rate, higher interest rate. So that is liquidity risk. I mean, also default risk. You add default risk premium to make the bond more marketable. And then maturity risk. First of all, default risk and the liquidity risk are firm specific, right? That are specific to the that firm. On the other hand, inflation risk. Inflation risk is not shown here, but in the earlier segment, inflation risk is already put there. Inflation affects. Inflation is not firm specific; it's across the board, right? Inflation affects all the company throughout the economy. So inflation risk, there must be an adjustment for that through risk premium, right? And then maturity risk. Maturity risk is literally the longer the maturity, the higher the risk. Why? The future is uncertainty, basically. Future is uncertain, and uncertainty is a risk. And this is uncertainty of the price movement, if you think about it, right? Obviously, if you compare a 1-year bond with a 30-year bond, right? 30-year has much longer, a maturity. I mean, with 1-year bond, maturity is not that far away, and pretty much, everything is, predictable, right? Within 1-year time frame, a lot of things are predictable, right? Interest rate movement is predictable. Therefore, the price movement is predictable. So there is, not that much risk compared to 30-year bond. I mean, for 30 years, in the 30 years into, for the next 30 years, who knows how the interest rate movement will be like. I mean, if interest rate goes up, right? If interest rate goes up, you remember there's an inverse relationship between the price of the bond and the interest rate, right? When the interest rate goes up, price goes down, right? When interest rate goes down, price goes up. So if the price goes up, then as a bond holder, it's a good thing for you, because if you sell the bond, you sell it at a good price. But if interest rate goes up, bond price goes down. If you sell, you can't probably recover the price you paid for the bond. You may not, right? Even recover the price you paid for the bond. So this uncertainty about interest rate movement is the risk associated with maturity. It's also called, therefore, it's also called price risk as well as interest rate risk, right? Because the risk is coming from the fluctuation in price. If it goes up, then it's not really a risk. It's not a risk. But if it goes down, it's a risk, right? There will be capital loss, because if it goes down below what you paid for, then you'll sustain capital loss. So each of these risk premium, each of this risk premia, the plural of premium is premia. Each of them has their own range. For example, default risk ranges between 0 to 8% on average, right? So what does that mean? If you have excellent credit score, like above credit score of 820, of course, you are not a company, you don't sell bonds, but for example, if you have excellent credit score, for businesses, for companies, that would be like AAA credit rating. And if the company has AAA credit rating, right, AAA credit rating, they will be the prime category. There is no default risk, right? There will be no default risk. So whatever is the Fed funds rate, or if it is a short-term bond, like 1-year bond, Fed funds rate is the bottom line, and 0% default risk premium is added. So it's just 3%. But you have to also factor in the inflation risk. So add in like 1% inflation risk premium. Could be 4. Then this could be 4%, right? And then liquidity risk, I don't know how, it could be 0 to 2%. And the maturity risk generally ranges between 0 to 2%, from 0 to 2%. So theoretically, interest rate or nominal interest rate, and K stands for cost of capital. Cost of capital is another name for interest rate. Why? What does cost of capital mean? That means the cost for raising capital. Yeah, that means cost of raising capital. So in other words, borrowing. Raising capital means borrowing money through selling bond. Or in interest, as in interest rates in general. If you borrow money, right, your interest rate is based on the pure return. Pure return is another name for real interest rate. then you remember nominal interest rate is real interest rate plus inflation, inflation premium, right? Inflation adjustment, then that should be nominal. But at the time when we talked about nominal interest rate versus real interest rate, we didn't consider any other risk premium, right? We didn't consider any other risk premium because, as I said, default risk, liquidity risk, they are all, company specific. So in general, we only need to worry about inflation. So that's why, in a simplified version, nominal interest rate is real interest rate plus inflation. Okay, but if you look more precisely, if you look into it more closely, there are more than just inflation risk premium, right? There should be default risk premium, liquidity risk premium, and maturity risk premium, right? So theoretically, this is nominal interest rate is composed of. Okay, just theoretically. And if you understand that, then we are done with this topic. I mean, there is also something we need to yield curve. We don't have time for this, so but the all my lecture videos explain very clearly about the yield curve and what is its why it is significant, what's its significance in finance. All right, so that wraps up everything about return on investment. So we are moving on to the next topic. We're moving on to the next topic, which is financial statements. And in financial statements, let's see. I don't think this is it. No. That's not the one. Where did I put it? Oh, okay. I'll have to download it. I'll have to go. Okay, go to course materials and. Let me download also. All right. So. Okay, I'll skip this one. All right, all right. So. Okay, Tristan is not here. Okay, here we go. Now, financial statements are basically, the fundamentals of business. Now, all businesses must, keep financial statements, and financial statements refers to basically there are four statements: income statement, balance sheet, cash flow analysis or cash flow statement, and retained earnings statement, right? So starts with this slide starts with balance sheet, but it's better to start with income statement. Okay. Also, I will.
Sir?
Yeah.
I have a question.
Yeah.
I literally, my last class.
You what? You did what?
In my last class,
Uh-huh.
1 hour ago, I
Uh-huh.
just did a test that included financial statements and all the stuff and balance sheets and all the stuff I'm seeing here.
Yeah, yeah.
Will this be similar or completely different?
No, of course it must be. I don't know what class it was, but was it what?
Accounting.
Yeah, yeah. It's similar. It's basically it's basically when we say balance sheet, when we say financial statements, it's the same thing, right? It's
Yeah,
across
but it might be
finance.
applied different.
No. In accounting class, in accounting, they don't think about the reasonings behind it. In accounting, the way they teach in accounting class, it's just like a prefabricated procedure. You do this, you do this here, you do that. But the in this class, we want to understand the logical reasoning behind it, right?
Exactly. That's
What
something I don't
comes
like
after?
about accounting.
Yeah. What
There's no
comes,
logic.
after this? Yeah. Why this comes after this step, and why it is called that? In other words, we are doing more of soul searching. The reasons
Yeah,
behind everything, right? So
exactly.
that's what we do in this class. So let's see if I have I opened it yet? Oh yeah, it's open. So let me I cannot write on PDF files, so let me just use okay. Let me use Excel file. So let's first think about, oh yeah, there's a lot of I wrote a lot there, scribbled a lot there, and but it's not that it's not interfering that much. First of all, let's take a look at income statement. Now, people often, even after taking accounting class or even after taking finance class, if you don't repeat it over and over, you tend to forget. And what is most disappointing when people forget is that they completely don't understand the goal, the reasons for difference in income statement and balance sheet. In other words, the goal, balance sheet and income statement, they serve two different goals. Their objectives are different. Okay, because whenever I ask this question, what are the, when I ask the questions, to the students who have already taken, accounting class or Finance 100, they still they give me the wrong answer. Why? Because they confuse basically the goals, the objectives of these two different statements. One, first of all, they all think these statements are all about profit. Of course, they think businesses are run. If you have a business, the goal is to maximize profit. Okay, all businesses, the goal is to maximize profit. And even this statement, when I ask the students, what's the why do the businesses exist? Then they say, to make money. Now that's a too vague statement, right? Vague statement. What is making money? I mean, what does that mean? Making money. If I work and I get paid salary, I'm making money, of course, right? But then, if I make, $10,000 a year, that's too small. Let's say if I make, $10,000 a month, right? That sounds better. If I make $10,000 a month, of course, I will have to, that's not the net income. That's the gross income. Isn't that right? Because first I will have to pay my expenses. What are the expenses? Food, shelter, clothing, the basic necessities. I mean, there's basic necessities of, life. Food, shelter, clothing, right? I have to pay rent.
Yeah.
I have to pay for food. I have to pay for, I have to pay the rent for shelter, right? And then that's the basic necessities. And plus, I have to pay other expenses like telecommunication and transportation, right? Even telecommunication and transportation, that's still very basic. Some people think, think about, social life and entertainment. Yeah, well, social life and entertainment, good. But, those are not the necessities, right? You can, I mean, when you have to tighten your belt, you can do without social life and entertainment. Isn't that right? And then, still, you have to go to work. You have to communicate with, and, you have to, during the pandemic, it's best not to it's best not to socialize or gregarious, not to be gregarious, meaning, getting together, right, during the pandemic, right, if possible. So social life, entertainment, but, still, you need, still telecommunication and transportation, right? Of course, heating and air conditioning and things like that. Heating and air conditioning, of course, that may be included in your. Heating is included in your. It may be included in your rent. At least, air conditioning may not be or may be, but telecommunications and transportation. I think this is fourth and fifth necessities, but basic necessities are food, shelter, clothing, right? So you have to subtract expenses from your gross income, and then you end up with your net income, right? But of course, before coming to net income, think about it. Oh, if that was gross income, then you must pay taxes, right? You'll have to pay taxes. And then whatever is left is your net income. With your net income, you can save it, right? You can save it or spend it. So that's called disposable income after paying taxes, right? Actually, after paying taxes. Uh, so and then after paying all the, food, shelter, clothing, for basic necessities. Even the basic necessities are part of the disposable income because anyway, it's at your disposal, right? It's at your disposal. The taxes, that belongs to the government, right? So that's not, even if you cannot pay the rent, you'll have to pay taxes, right? Um, because tax is mandatory. But anyway, after paying taxes, after paying all these, after paying taxes is called disposable income, and after paying, for bare necessities and food, shelter, clothing, and transportation and telecommunication, um, then that's a net income, right? But if it is a company, right? If it is a company, after paying all the expenses and the um, taxes, right? You end up with net income. That net income for a company is called profit. Profit, right? For an individual, for a person, it's called net income. But for a company, that's called net profit. Okay. So that's basically the structure of the income statement, if you think about it. Structure of the income statement. There is income, right? Your gross income is mainly your labor income because your paycheck is your paycheck is the payment for providing your labor, right? Be it mental labor or physical labor, still the same thing. And then from that, you have to pay your expenses, right? And then pay taxes, and then you end up with the net income. But that structure is very similar in a company, right? So the income statement is, and I was starting with the goal of the financial statements, and I said, income statement and balance sheet have different goals. They serve different purposes. So first of all, goal of the income statement is profit. It's about profit. Goal of the income statement is to describe the process, right? To describe the process, to give you a full picture of how you arrive at net profit. Okay, that's the goal of the objective of the income statement. But the balance sheet has nothing to do with profit. Balance sheet it's not the goal. It's not the goal of the balance sheet. And what is the goal of the balance sheet? The goal of the balance sheet is to describe the capital structure. Goal of the balance sheet is to describe the capital structure. Okay, what is the capital structure? We'll get to that, but at this point, all you need to understand is, about the balance sheet is, the goal is to describe how much of its total assets came from debt and how much of it came from equity, right? In other words, did 60%, how much is equity of this company's total assets? 60%, 70%. If the equity is 60%, then the debt will be 40%. If equity is 70%, then the debt is 30%, right? That's the composition of capital that was used to acquire the assets, total assets, right? So it's totally, goal of income statement and balance sheet are totally different. And if you say, oh, when looking at the balance sheet, if you're trying to look for clues about the profit, then you are grossly, mistaken. Of course, you can take a glimpse. You can take a glimpse at profit. I mean, it can be, but then, when you're comparing two, balance sheets at, in other words, at two different time points, like, at time 0 and at time 1, you can get an idea about the profit, but the goal of the balance sheet is not profit. So here, let's take a look at the income statement first. First of all, the full income statement is also called, the full name of income statement is income and expenses statement. And that means, income statement has two components, income and expenses. Of course, income is, money that comes in. Expenses, money that goes out. You have to pay out expenses, right? But then you have to, what are the income? I mean, what are the sources? What are the sources of income? There are largely two sources of income, two sources, right? And also largely two sources of expenses. So most of the income, the primary source of income is sales revenue. Think about it. Primary source of income is sales revenue because all companies must sell something, right? And the revenue is what you receive, right? Revenue is the payment that you receive for selling something. That's the verbal definition. But I don't like verbal definition. We don't, because verbal definition is always, cloudy, right? It's open-ended. When I ask, what is revenue? Students try to come up with some verbal answer. But then this answer varies from one person to another. And that's not acceptable. If it varies from one person to another, that is not that is inconclusive, or it's open-ended. Literature likes something open-ended, but science doesn't like open-ended. Science doesn't like open-endedness. Science must be closed-ended. Everything must have definitive answer, closed answer, right? And anybody who repeats the same process must also arrive at the same answer, right? As long as you use the same process, you must arrive at the same answer. That's science. But the literature is not like that, right? There's no two processes are the same. They don't even want the same process. And even if they use the same process, you still end up in different answers, right? That's basically the difference between science and art, right? In art, closed answers are not celebrated. But in science, open-ended answers are not celebrated. It's a pariah. Open-ended answer like, I don't know, it depends. This kind of answer is a pariah. That means simply it's nothing but, well, you don't know. It's another way of saying you don't know. You don't have any concrete idea. You don't have any answer. It's just easy to say it depends. But you don't have any answer, right? You don't know. It's just another way of saying, you don't know. You have no idea. But you just don't want to sound like you are ignorant, right? So that it's easy to say, it depends, right? maybe ignorant is not the word, but you just don't have the idea. But just don't want to look like you have no idea. So then you say, it depends. But that's open-ended answer, right? Because that means it can be anything. That is not celebrated in science. That is pariah. It's something only the that's a statement, another statement that that person is not very smart, or but in arts, it doesn't matter. They don't in arts, they don't like closed answer, right? So that's the difference. In arts, they like open-ended answer. Anyone was trying to say something? I heard some microphone. Um, we're almost out of time, but here. So before I go, yeah, primary source of income is revenue, and secondary source of income is investment income. Investment income is a broader. Investment income is a part of a kind of passive income. Passive income, right? So sales revenue is, I don't necessarily call it active income, but by selling, this is a revenue generated by selling something. So you can consider that active income, but it's just a classification, and they don't. I haven't seen any classification like active income, but passive income is a legitimate legitimate terminology, and passive income is literally income that is generated not by your operating activity, right? Not by your business activity, but income like interest from lending, right? Or interest from uh, or the rental income, right? Rental income, right? Um, or investment income. That's all passive income, right? There are two sources. And revenue. Now here, let me talk. Let me define revenue. Revenue is price times quantity sold. Okay, this is the mathematical definition of revenue. Now think about it. You're selling computers, and let's say you have just one model, one brand, one model, and one brand, this same brand, one model, they must be all the same price. So let's say the computers are $500. This model is $500. If you sell one computer, just one unit, your revenue is $500. But if you sell 10 units, your revenue is $5,000, right? Isn't that right? If you sell 100 units, your revenue is $50,000, right? You sell 1,000 units, your revenue is $500,000. So isn't that what revenue is, right? If you sold, 1,000 units, it should be exactly price times 1,000. If you sold one unit, just price times one, right? Sold 10 units, price times 10. So that's the definition of revenue. Okay, please put in your brain, right? Register this into your brain from today. No verbal definition is necessary. Verbal definition is, not fail safe. It's not infallible. A verbal definition is not hitting the nail on the head, right? Not exactly hitting the nail on the head. But mathematical definition is always hitting the nail on the head with no excess, no frills, no excess verbiage. It's concise, it's succinct, it's terse, it's compact, it's condensed, right? No fat. There's no excess, no fat or frill. It's just the gist. It's the gist of it. It's the gist of the revenue, isn't it right? Price times quantity sold. And then think about it. If you have one model only, yeah, that works. But what if you have three different models? Three different models. Well, all you do is, okay, price of model 1 times quantity sold of model 1 plus price of model 2 times quantity sold of model 2 plus price of model 3 times quantity sold of model 3, right? So still price times quantity, isn't it right? Everyone, so far, everyone can follow this? Everyone?
Yes.
Okay, good, good. So please register this in your mind from today. Revenue, no verbiage, no unnecessary, cloudy, nebulous verbiage is needed. Foggy, fuzzy verbiage is needed. Simple and straightforward. Price times quantity sold. Okay? All right, we're out of time, so I will have to say goodbye now. So the class is dismissed. Have a good rest of the day.
Professor, I have a question.
Yeah.
Yeah, so since we started on the topic 2, does that mean we need to get into Connect right now?
Yeah. Actually, I'm gonna post. You guys all ran out of the trial access. I mean, if you already have the book and your access code, then you can use it. But for those people who are still waiting for the book, I have so-called, a super code, which extends the trial access for another 2 weeks. But I know some people. There is always, temporary courtesy access for 2 weeks, but some people have already used it. It doesn't start when you start. It starts the trial 2 weeks starts when the first person activates that trial access. So if the first person activated that trial access on August 31st, 2 weeks have already lapsed. Long time ago. And if the first person activated it like 2 weeks ago, today is the tail end of 2 weeks. So nobody can, because of that first person, right? If you haven't activated the trial access, you can't even get a chance. If you have your own access code, if you got the book already and own access code, no problem. But for those who are still waiting for the book, I will post an announcement today about that super code that will give you another 2 weeks. Okay? All right, everyone. Any further questions?
No, that's better.
All righty, good. So I'll see you guys next Monday, and I will post that announcement today. All right?
Have a good weekend.
All right.
Okay,
All
thank
right,
you.
you
Have a
too.
good weekend, Professor.
Thank you,
All
Professor.
right,
Thank you
too.
so much.
Thank you.
Bye-bye, everybody.
Take care.